Welcome back. Today on the Byte-Size Brief, we're going deep on United Parcel Service, or as we all know it, UPS. We're looking at a massive, ongoing transformation happening right now, as of May 6, 2026. This isn't just some minor operational tweak. No, UPS is literally resetting its entire network. It's kind of like they're rebuilding the airplane while they're flying it. And to understand why this company deserves your absolute attention right now, we need to look at one specific, honestly shocking metric that proves the old way of doing business is officially dead. Let's dive in. 8.8%. Just a short time ago, Amazon was making up over 13% of UPS's total revenue. Today, that number has been aggressively engineered down to 8.8%. They are intentionally walking away from hundreds of thousands of Amazon packages every single day. It's a dramatic shift, and it proves a massive strategic pivot is already well underway.
So here's our agenda for today's explainer. 1. Introduction and overview. 2. The UPS business model. 3. Q1 data and restructuring. 4. The bull versus bear case. And 5. Future roadmap and conclusion.
All right, moving to Section 2, the UPS business model, specifically shifting from volume to yield.
For years, the old industry assumption was pretty simple. Scale alone drives profit, right? The old UPS strategy was all about chasing volume. That meant a heavy reliance on massive e-commerce players like Amazon, which, as you might guess, usually resulted in really low profit margins per package. But the new UPS strategy? It's a total 180. They are now chasing yield. They're prioritizing premium, high-value packages in the healthcare sector, B2B shipments, and consolidated returns. They are completely overturning the assumption that more packages automatically equals a better business.
Let me give you a concrete analogy to explain how this actually plays out in the real world, especially with the booming returns market. Think about the traditional delivery model. A UPS driver burns gas and time driving to 20 different houses just to pick up 20 individual low-margin packages. The cost to serve is just incredibly high. Now, consider the new UPS approach using their Happy Return subsidiary. Step 1, a customer does a boxless drop-off at a retail location. Step 2, 20 returned items get consolidated into one single bin. And Step 3, UPS ships that single, dense bin through their network. Instead of 20 costly house visits, UPS makes one high-margin pickup. It's a perfect illustration of their new business model, density and yield over sheer volume.
Okay, Section 3, Q1 data and restructuring. Let's look at the actual cost of this change.
Take a look at the wild dynamic playing out right now. U.S. average daily volume is down 8% year over year. Almost two-thirds of that drop is intentionally from that Amazon glide down we talked about, actively removing lower-yielding e-commerce. But wait, U.S. revenue per piece is actually up 6.5%. They're moving fewer packages, sure, but the packages they do move are significantly more profitable. So, on the top line, the yield strategy is clearly working. But it absolutely comes with a steep short-term cost. Let this data sink in for a second. 4%. Despite a massive revenue beat of $21.2 billion for the quarter, the U.S. domestic operating margin fell to a severely squeezed 4%. So you're probably wondering, if revenue per piece is up, why did operating margins actually fall so sharply?
Well, the logic behind that margin drop is found in $350 million of short-term cost pressures that management faced this quarter. It's kind of like a perfect storm of specific factors. First, inclement weather and higher casualty expenses. Second, aircraft leases. They had some temporary third-party lease expenses because they're retiring their older MD-11 fleet while they wait for new 767 deliveries. And third, transition costs tied to Ground Saver, where they're shifting some lower-yielding last-mile delivery volume over to the U.S. Postal Service. Basically, these are the very expensive growing pains of a massive network reset.
And look, this restructuring isn't just sanitized financial data you hear on an earnings call. It is physical and it is aggressive. To balance out those numbers, we have to look at the friction happening on the ground. UPS is reconfiguring its network by closing 51 facilities in total throughout 2026. They've also launched a driver choice buyout program aimed at eliminating 7,500 full-time driver positions, which, crazy enough, was actually oversubscribed by employees. And like we mentioned, they are actively shedding 500,000 Amazon packages from their daily load. This is a deliberate, painful, but ultimately necessary shrinking of capacity to match their new lower volume reality.
All right, Section 4, the bull versus bear case. Optimism versus ground reality.
Let's start with the bull case, anchored right at the top by the optimism of the C-suite. CEO Carol Tomé stated in the recent earnings call, "We're winning through innovative and differentiated capabilities, doing a better job retaining and growing our existing customers." The management team firmly believes that this messy period of transition is setting the company up for massive long-term margin expansion. And to be fair, they definitely have the numbers to back up this optimism.
Let's look at the concrete metrics driving that bull case. Small and medium business, or SMB, penetration just hit a record 34.5% of total U.S. volume. That is highly profitable, premium volume. Furthermore, their healthcare revenue just hit $3 billion for the very first time. That's a sector that typically boasts double-digit operating margins. From a valuation standpoint, UPS is trading at a forward price-to-earnings ratio of 15. That makes it look significantly undervalued compared to its main rival FedEx, which is sitting at a PE of 20. If you believe this restructuring is nearing the finish line, the upside potential here is totally robust.
But as an objective explainer, we've got to give you a bit of visual whiplash to ensure you get the complete picture. Let's juxtapose that C-suite optimism with some real candid frustration straight from a UPS employee Reddit board. One user wrote, "Closing the customer counters was the dumbest, most short-sighted thing in a long line of dumb things. Expectations are impossible to reach." See, while management sees streamlined efficiency, a lot of employees and local businesses see a severe degradation of service and a loss of crucial community touchpoints. And this perfectly introduces our bear case. The bear case presents some very specific, tangible risks that we absolutely cannot gloss over. First, exactly as that quote alluded to, there's a real risk of lost accounts due to closing those customer counters and facility consolidations. Second, Amazon isn't just stepping back as a customer. They are expanding their own supply chain services to outside businesses, turning them into a direct, formidable competitor. Third, you've got macro risks, sudden Middle East fuel price spikes directly impacting operational costs. And finally, the upcoming elimination of the de minimis tax exemption in Europe this summer. That could severely disrupt international e-commerce flows. These are real, incredibly complex threats.
Okay, moving to our final section, Section 5, Future Roadmap and Conclusion. Here is exactly what to watch next. If you want to determine if this restructuring is truly a success, keep your eyes glued to this timeline. Step 1. By June 2026, the 50% reduction in Amazon volume, that glide down we keep mentioning, will officially be complete. Step 2. In the summer of 2026, we're going to see the true impact of that European de minimis elimination on international margins. And Step 3, which is arguably the most important, management has pointed to the second half, or H2 of 2026, as the expected margin inflection point. That's the exact moment when the short-term costs of restructuring should finally fall away, and those higher yields should start generating real, sustained profit expansion. So the crucial tension of this entire explainer really comes down to this. A leaner, more agile company, or a network stretched too thin? Is UPS emerging perfectly positioned for premium logistics, or are they giving up vital market share and alienating their workforce just to chase a short-term margin bump? For logistics followers and retail investors alike, this is exactly why this transformation matters so deeply.
Which brings us to our final, provocative question. Will UPS's shrink-to-grow strategy ultimately pay off for shareholders? We've laid out the data, the strategy, and the very real risks. Now, it's over to you. That wraps up today's deep dive explainer on United Parcel Service. For a sharper, more candid discussion, keep tuning into our explainers. Drop your questions and takes in the comments. We read every single one.